Hello everyone, I hope you guys are doing well and your studies are going in full swing. In today's class, we would be discussing all the important questions for Ind AS 40 as well as the entire concept based revision. So this is a standard which is important and in a lot of times it is kind of clubbed with Ind AS 16 type of PPE questions. So what is an investment property? Now basically as per Ind AS 40, there are four essential ingredients. First, it comprises of land or building or both. So there are no other assets like cars, etc., which can come under this standard. It is either land, building, or both, which is owned by the entity or taken under a right of use asset. So basically, that should appear in the entity's balance sheet. And thirdly, it is held primarily for the purpose of earning rental income or capital appreciation or both. So this is the most important point. So the primary objective for which you are holding this is not for own use or for held for sale. It is for the purpose of earning rental income or capital appreciation or both. Like for example, if you have a classroom in Mumbai which you are using for the purpose of teaching, that is your PP, held for own use. However, if you buy a, let's say, plot of land somewhere, let's say in the outskirts with the intention that the price will go up eventually, then that is considered to be an investment property because it is probably held for capital appreciation or it is held for the purpose of earning rental income or both. But it is not for own use or it is not held for sale. If it was, then it would have been PP or inventory as the case may be. Now a few clarificatory points over here would be that what all will be covered under PP. So assets that you have purchased or taken on right of use and given out on operating lease will be covered under investment property. Given out under operating lease. Now sometimes it might happen that these assets are currently lying vacant or they are currently under construction. So they are not yet given on operating lease, but let us say at the time of initial classification, okay, initial, not subsequent, initial classification, your intention is to give it out on lease. You have appointed tenants who are brokers who are trying to search for tenants. It is still classified as an investment property. However, if you are holding it for your own use, then it is PP. Now, borderline cases would involve employee occupied property where employee is probably paying rent, maybe at a concessional price. However, if it is employee occupied property, typical Ind AS 16 will apply because the underlying objective over here is largely not earning rental income but doing employee welfare, and hence it will be governed under Ind AS 16. Now there is an interesting discussion that arises that what will be the case in case the property currently is there but it is for undetermined use. I don't know whether I'm going to ultimately use it for my own business or for the purpose of giving it out on rent, and hence the standard says in case of vacant property which is for undetermined use, Ind AS 40 will apply. Now this could have been a grey area, it could have gone either way. However, Ind AS 40 very clearly tells you that you should cover this under investment property, and hence properties held for undetermined use will be classified as investment property. This is an important point which can come in the exams as well as in the possible MCQ case. Okay, now when we look at properties, sometimes some properties might have dual use. Like for example, there may be a 4-floor building out of which 2 floors are held for own use and the remaining 2 floors are held for the purpose of earning rental income, in which case we will try to proportionately split. Let us say it's a 40 crore building, 20 crores will be PP and 20 crores will be investment property. That is because these floors are separately sellable. However, if you are not able to separately sell these items, like if it's a 4 BHK, a 4-bedroom flat, 1 bedroom is held for own use and the other 3 bedrooms are given out on rent, in which case you cannot separately sell those bedrooms without selling the entire property including the PP, and hence in such a case the standard says the entire asset would be shown as a PP unless we can say that the own use component is insignificant, and unless given otherwise we will never assume that the own use component is insignificant. So over here probably the logic over here is because investment property is usually treated as a surplus asset, and hence if a shareholder sees a 40 lakh flat out of which 10 lakh is PP proportionate and 30 lakhs is investment property, they might require you to sell that flat and get 30 lakh rupees. However, if you sell that flat, your own used asset will also be sold, and hence the standard says, well, you know what, we want to do a fair presentation, so let us not separately segregate it because you cannot separately sell it. So how do you show this? Well, it could have been shown either way around. The standard says you entirely show it as PP unless the own use component is insignificant. Okay, again we have just given a summary on what will happen if it's an owned property or the property which is taken on rent. If it is used for own use, PP will apply. If it is given out on operating lease, then Ind AS 40 will apply, at least for recording the asset. Then if it is held for sale in the ordinary course of business, Ind AS 2 will apply. If it was meeting Ind AS 105 conditions, then it can be shown as a non-current asset held for sale. And if the property is sold or it is given out on finance lease, the property will be derecognized from the books, and hence there is no question of a classification that can arise. If the question remains silent and it just says the property is given out on lease or intended to be given out on lease, we assume that it is intended to be given out on operating lease and not finance lease, because finance lease is treated to be equivalent to a sale. Okay, next, when we have discussed, I think, this dual use property as well. Next, when we go to accounting, now the accounting principles of Ind AS 40 are by and large similar to that of Ind AS 16, that is PP. Initial recognition happens at cost. At subsequent expenditure, you can capitalize if it increases the life or efficiency beyond what is originally assessed, or there are major replacements, etc. At the time of subsequent valuation at each balance sheet date, one needs to remember that you will have to follow the cost model. Remember, if you look at International Accounting Standards, IAS, it does allow you to follow what is called as a fair value model. But under International Accounting Standards, if there's a gain or loss, so let's say your property was purchased at 100, now the property is 120, that 120 rupees gain will also be taken to the P&L. Now in India, we don't agree with that treatment, and hence the fair value model is not permitted for investment property. That is a very important thing that you need to remember. PP, it is permitted, in investment property it is not. However, because it is for investment, the standard says fair value should be disclosed, where in the notes to accounts, though you will never account it in the books of accounts, you will just disclose it. And how will you determine the fair value? Well, using internationally accepted principles and practices. At the same time, you will also consider the valuation experts who will be determining, disclose the assumptions used, inputs used, techniques used. All of this will be given in disclosure, not to be accounted. One needs to again distinguish this from PP, where in PP, if you follow the cost model, fair value need not be disclosed. If you are following revaluation model, fair value will be used for the purpose of revaluation directly in the books of accounts. But in investment property, you cannot revalue, but you have to disclose the fair value in the notes to accounts. So that is something that you should be clearly aware of. Now, one more kind of myth, if we call it, over here is that because it is investment property, it cannot be depreciated. Well, usually we do not depreciate investments primarily because these are financial assets, and financial assets don't directly depreciate. However, investment property, if it comprises of land, yes, it does not get depreciated. But if it comprises of building very well can get depreciated and should get depreciated irrespective of whether it is investment property or PP. So if there's a building component within investment property, very well, yes, you will charge the depreciation on that as well. Okay, everything else regarding depreciation, component method, etc., all remains the same. In case the fair value of this investment property is not determinable, then in the notes to accounts, instead of disclosing the fair value, you will mention the reasons why fair value is not determinable. Now comes reclassification. So can you reclassify from investment property to PP or vice versa, or investment property to inventory or vice versa? Answer is yes. But when can you reclassify? Remember, what we discussed earlier was regarding initial classification. For subsequent classification, one needs to remember that your subsequent reclassification can only happen if there's an actual change of use. A mere intention to change is not sufficient. Like, for example, if I'm using the property for my own use, I'm kind of fed up, I say I don't want to continue this business, I'll give it out on rent. Have you given it out on rent? Not yet, and hence till that time you will continue to show this as PP only. Once you kind of stop production and tenants actually move in, that is treated as an actual change in use. And whenever there is an actual change in use, only then can you reclassify. Initial classification can be done based on intention, or if it is vacant, then it can be treated as investment property. But subsequent reclassification can only be done when there is an actual change in use and not merely an intention to change use. Again, when you reclassify, one needs to remember that the reclassification has to happen based on the carrying value, that is a ledger balance appearing in the asset at the time of reclassification. Now, there are a couple of special cases in general, especially in case of parent subsidiary. So if there is a property which is given on rent by the parent to the subsidiary, then in the parent's SFS, it will still be treated as an investment property, because by the way, subsidiary is a separate legal entity. In a subsidiary's books, it can be treated as an ROU asset, or as a case maybe if it's a short-term lease, then it is a direct lease as per Ind AS 116. But when I prepare the consolidated financial statements, the accounting will depend on how the property is ultimately being used by the subsidiary. So if the subsidiary uses it for its own use, then for the group as a whole, it is treated as PP, irrespective of how it was classified in SFS. However, if the subsidiary gives it out on rent, that is sublets it, in which case this will be treated as an investment property for the group as a whole. So that is something that you have to remember for CFS. There's an exam question also on that we will discuss. And lastly, when we are looking at a entity whose business is earning rental income, like a hotel for example, then for a hotel, the hotel properties may be land or building. However, along with earning pure rental income, I'm also providing a composite. I provide substantial other services, and hence the standard says in such cases they will be treated as PP. So if you are providing substantial other services, then the treatment will be that of a PP and not as investment property. So these are, I think, the important pointers. There are three important questions that we want to discuss over here. Question 1 is there in your study material and RTP. 2 and 3 are past exam questions which are fairly interesting. So what we'll do is we'll try to go to question 3 first. Actually, that is one of the 4. We have kept 4 questions over here. Chalo, so there's a lot of things to do. Chalo, let's quickly discuss this. One, I mean, it is a fairly detailed one, but manageable, I would say. The other questions are a little more tricky. Now, Shaurya owns a building A, which is specifically used for the purpose of earning rental. So this shows that it must be an investment property. The company has not been using building A for any of its facilities or own use for a long time. The company is also exploring the opportunities to sell the building if it gets a reasonable amount of consideration. Now some people think that this will make it non-current asset held for sale. Answer is no. Remember, for non-current asset held for sale, an active process has to be initiated. Merely contemplating is not enough, and as a result this is not under Ind AS 105. It will still be covered under Ind AS 40, that is building A. Now following information is relevant for building A for the year ended 31st March 2012. Building A was purchased 6 years ago at a cost of rupees 10 crores. So this is 6 years ago, probably from 31st March 12. If you were given the data on 1st April 11 and you were told that building A was purchased 5 years ago, then that will be 5 years from 1st April 11. So depends on from which date you are counting. And the building is estimated to be having a life of 20 years. The company follows the straight line method for depreciation. So overall life is 20 years, and hence if you go to see, the depreciation over here will be 10 crores divided by 20, that is probably 0.5 crores per annum. Now till date 6 years have gone by, and hence 0.5 into 6, that is equal to 3 crores would have been the total depreciation. However, during the year, out of this 3 crores, 0.5 crores would be charged during the year, and hence the opening balance. So till the start of the year, that is 1st April 11, 5 years would have gone by, and hence the accumulated depreciation would have been 2.5 crores. Further during the year, there will be another 0.5 crores of depreciation. Now during the year, company has invested in another building, that is building B, with the purpose to hold for capital appreciation. Again, if it is for capital appreciation, this is investment property. The property was purchased on 1st April 11 at the cost of rupees 2 crores. Expected life of the building is 40 years. Now this was purchased at the start of the year, so this is like an addition during the year. Expected life is 40 years and company follows straight line method of depreciation. So this is, I think, cost of 2 crores divided by 40, and hence this will come to 0.05 crores depreciation during the year. Opening, there would be no depreciation because the property is purchased during the year only. Further, during the year 11-12, the company earned or incurred the following direct operating expenditure. Remember, this is not an expenditure for construction or acquisition, it is for operation. Question very clearly tells you that. Relating to building A and building B. Rental income from building A will go to the P&L income. Rental income from building B will go to the P&L as income. Sales promotion expense again goes to the P&L as an expense. Fees and taxes, P&L as an expense. Ground rent, I'm assuming we don't own the ground, so we have to pay rent for the ground, so that will go to the P&L. Repairs and maintenance, again P&L. Legal and professional charges and commission and brokerage. Now ICAI has taken both of these to P&L. Now some students say that if building B was acquired during the year, these expenses must have been incurred for acquisition of building B. Could have been possible, but if the question very clearly tells you that these are direct operating expenditure, maybe these are expenditure for operation of these assets. Maybe you might have paid legal fees to a broker or a commission to a broker, legal fees for stamp duty, registration of the tenancy agreement. Now that is a rental agreement, and as a result that will go to the P&L account, for example. So basically, because it is directly operating expenditure, all of this will go to the profit and loss account. Now the company does not have any restrictions and contractual obligations against the property A and B. For complying with the requirements of Ind AS, the management sought an independent report from specialists so as to ascertain the fair value of the buildings A and B. But why are we ascertaining the fair value? You have to show it using the cost model. Yes, but we still have to give a disclosure. The independent valuer has valued the fair value of the property as per the valuation model recommended by the International Valuation Standards Committee, and it has been computed by streamlining the present value of future cash flows like the DCF. So over here we will say that the valuation in the disclosure has been done by independent valuers who have used internationally accepted methods, that is the DCF method. The other key inputs for valuation are the estimated rent per month per square feet is expected to be 50 to 60. It is expected to grow at the rate of 10%. So this is one assumption. 50 to 60 expected growth rate, 10%. Second assumption, for 3 years, that is a tenure, and the weighted average cost of capital will be 12 to 13%. So that is the third assumption. Assume that the fair value of the properties based on the DCF is measured to be 10.5 crores. The treatment of the fair value of the properties is to be given in the financials as per the requirements of Ind AS. So over here, this is probably 10.5 crores. This will be used for the purpose of disclosure. Maybe you don't have a breakup between A and B, but the total fair value is, for example, 10.5 crores. What would be the treatment of building A and B in the balance sheet of Shaurya Limited? So in the balance sheet, they will be shown as investment property. Provide detailed disclosures. Disclosures will have a fair value disclosure of 10.5 crores along with the assumptions and the methods used, and computations in line with the relevant Ind AS. Treat as if you are preparing a separate note or schedule in the balance sheet. So if I were to look at a separate schedule in the balance sheet, I have to show the assets at original cost. So my building A and building B, in loose terms, building A would have an original cost of 10 crores. Building B, opening there is nothing, but during the year there's another 2 crores, and hence in total your original cost will be 10 and 2, that is equal to 12 by the end of the year. Now if I look at accumulated depreciation, by the start of the year for building A there is a 2.5 crore accumulated depreciation, nothing for B. During the year a further 0.5 crore depreciation, and for B another 0.05 crore depreciation. So your accumulated depreciation is 3 crores as well as 0.05 crores by the end of the year, so that is around 3.05. And if I look at the closing balance at the start of the year, I would say that building A was 10 minus 2.5, that is equal to 7.5. Building B was 0. By the end of the year, building A is 10 minus 3, that is equal to 7. Building B is 2 minus 0.05, that is 1.95. So by the end of the year, this is equal to what? 8.95. So if I were to prepare the balance sheet, 8.95 is the carrying value of the investment property that will appear as a separate line item within non-current assets. Further, a disclosure of 10.5 crores will appear in the notes, and the other expenses and incomes, as the case may be, will go to the profit and loss account. This is 895 lakhs or 8.95 crores. A detailed breakup, extracts given, and the summary of key assumptions. So that is question number 1. Next you go to question number 2, which is an exam question. Most of the other questions can be possible exam questions. On 1st April 19, an entity purchased an office block, that is building, for 50 lakhs and paid a non-refundable property transfer tax and direct labor cost of 2 lakh 50 and 50,000 respectively while acquiring the building. So these are directly attributable to acquisition and hence they should be capitalized. So total building will be at 53 lakhs as we speak. During 2019, entity renovates the building into a 2-story building. So after acquisition, we are making changes to get it ready for our intended use. So these are expenditures. On redevelopment were 1 lakh for building plan approval. Will you capitalize? Yes. 10 lakh construction costs including 60,000 of refundable purchase taxes. Refundable purchase taxes are not to be included. However, if I start at 53 lakhs, to the 53 lakhs, I will add the 1 lakh over here. And I will also add 10 lakh minus 60,000, that is 9 lakh 40,000 over here. 40,000 due to abnormal wastage of material and labor. So in this question, have we been told that the 40,000 is already included as a part of 10 lakhs or already included as a part of 1 lakh? No. So in line with the institute's solutions, we are assuming that this is additional 40,000. However, abnormal loss is not a part of the cost and hence it will not be considered, and hence if I were to take the total value, this is what? 54 and I think 63 lakh 40,000, which will be the total cost for the 2-story building. Now, when the redevelopment of the building was completed on 1st October 19, so probably took 6 months from 1st April 19 to 1st October 19 for this redevelopment, the entity rents out the ground floor of the building to its subsidiary under an operating lease in return for a rental payment. Okay, so I'm giving out the ground floor. We don't know how much area the ground floor takes, but whatever it takes, let us say half of the area, I'm giving it out on rent, by the way, to my subsidiary, but in my SFS, that's a separate legal entity, for a rental payment. So in the SFS of the parent, which would be whatever the name is, we will treat this as investment property, at least towards the ground floor. The subsidiary uses the building as a retail outlet for its products. So subsidiary might show it as a right of use asset, maybe a right of use PP under Ind AS 116. But in the CFS, I will say that this ground floor, now parent and subsidiary becomes one and the same. So in CFS, this ground floor will be taken as PP again, but in the SFS of the parent, it is slightly different. We'll do a summary on this. The entity kept the first floor for its own administration and maintenance staff. So that is very clear. This is PP. Equal value can be attributable to each floor. Perfect. How will the entity account for the above mentioned expenses in the books of accounts? So if I look at the ground floor And if I look at the first floor, if I look at the allocation, they have told you that the allocation is equal. So 63 lakh 40 divided by 2, that is approximately 31 lakh 70, 31.7 lakhs and 31.7 lakhs attributable to each of these floors. Now, how will they be calculated or shown in PCFS, in subsidiary, in PSSFS, in subsidiary SFS and in CFS? Now, if I look at the ground floor, P is giving this ground floor to rent to its subsidiary and hence P will show it as investment property. First floor, it is using it for its own use and hence it will show as PP. Now, when I look at subsidiaries books, subsidiary is not getting the first floor and hence there is no question of classification for the first floor in subsidiaries books, but subsidiary is getting the ground floor and hence Ind AS 116 would say that subsidiary is a lessee and hence it will record a right of use asset in all likelihood. If it is using it for its own use, this is a right of use PP. In my CFS, my ground floor will be taken as PP because ultimately for the group as a whole, I'm using it as a retail outlet. If the subsidiary has sublet it to someone else, then my classification will be slightly different, but that is not the case over here. So this will continue to be, let us say, PP. First floor in any case is PP. So the values over here, at least for the P, SFS and CFS, would be 31 lakh 70 for each of them. So also discuss how the above building will be shown in the CFS of the entity as a group and in the standalone statement. So that is what we have discussed. Okay, then you go to question number 3. This is also a recent exam question, I think May 22 question. So this is more of a theory base on classification and reclassification. Now X owned a land property whose future use was not determined. So this is investment property as on 31st March 11. How should the property be classified in the books of X? If use is undetermined, it is investment property. Now during June 11, that is in the next year, X commenced construction of office building for its own use. So has there been an actual change in use? Yes, you have actually commenced construction of office building for own use, presuming that the construction of office building will still be in progress on 31st March 12. Now can you reclassify? Yes, because there's an actual change. How should a land property be classified in the financial statements? Well, it will now be PP under construction. Maybe you can even show it as capital work in progress, but it will be within Ind AS 16 principles. Will there be any change in the carrying amount of the property resulting from change in the use of investment property? Answer is no. Remember, because the reclassification also happens at the carrying value. So whatever was the carrying value will be taken as a base for the purpose of the reclassified item. Whether the change in classification to or from the investment property is a change in accounting policy to be accounted for as per Ind AS 8. Answer is no. Remember, it is a change of fact. Accounting policy change will require a retrospective restatement. So why should I retrospectively restate and show it as PP for the past years? Because as a matter of fact, in the earlier years, it was, by the way, investment property. Now there have been changes in the facts of the case, because of which now you have been showing this as in PP, but that does not qualify to be a change in accounting policy. It is a change of fact. And the last and the most tricky one, would your answer to sub point A, what was my answer to A? Well, I'm showing it as PP, be different if there was to be a management intention to commence construction of an office building for own use. However, there is no construction activity which was planned till 31st of March 2012. Will there be any change in such a case? The answer is yes. Remember, reclassification can only happen if there's an actual change in use. A mere intention to do something is not sufficient, and hence till that time your classification will continue to be investment property. Remember, this is a case of reclassification because initially you have already classified as investment property, and for you to reclassify something from investment property, that can only be done if there's an actual change in usage. This is just a mere intention to start construction. You have not started construction in point D, and hence we will continue to show this as an investment property only. Now the last question I would reckon is the most important question. It has Ind AS 16 as well as Ind AS 40 implications. So fairly interesting. A lot of accounting adjustment should be clarified here. So this is question number 4. Now Special Limited is a multinational entity that owns 3 properties. Okay, the 3 properties were purchased on 1st April 2020. So all of them have been purchased on the same day. Let us say 1st April 2020. The following details are furnished. Okay, property 1, purchase price and estimated life. Fair value is on 31st March 21. That is after 1 year. Now if I go to see if my life is 10 years, then ideally there should be a depreciation of 75,000, and hence this property 7,50,000 minus 75 should be at 6,75,000. This is irrespective of whether you classify it as PP or whether you classify it as investment property, depreciation will happen. Second is 10,50,000. The life is 15 years. 10,50,000 divided by 15 and you get 70,000. So over here you will subtract 70,000 and hence this will come to probably 9,80,000. Now again, this is irrespective of whether you show it as PP or investment property, it should be 9 lakh 80. And third property 12 lakhs with 15 years. So if you do 12 divided by 15, it is I think 80,000, and hence your asset of property 3 will be shown at 11 lakh 20,000. Okay, this should be your carrying value on 31st March 21. The company uses property 1 and 2 for its business purpose. So perfect. Property 1 is PP. Property 2 is also PP. The company is exploring the opportunity to sell property 3 if it gets a reasonable consideration. Till that time it is not sold, the company has rented the property. So you are now holding it for the purpose of earning rental income or capital appreciation, hence property 3 is investment property. It has adopted the revaluation model for subsequent measurement of these properties. These bole to 1, 2 and 3. Acha, you can very well follow revaluation model for property 1 and 2, but you cannot follow it for property 3. So that is the first error. You cannot follow revaluation model for property 3. Second, the depreciation is charged on a straight line method. That's fine. However, the company has not charged any depreciation on property 1 and 3 for the current year since the fair value of the properties exceeds their carrying amount. Now, this is a second error. Let the fair value be 8 lakhs. Let my carrying value be 7 lakh 50, 6 lakh 75, whatever it is. To say that I will not depreciate because the fair value is higher is wrong, because remember, revaluation can happen at sufficient intervals, and because you are revaluing does not necessarily mean that you will not depreciate. Like, you will probably after this you will decide that you will revalue after 5 years. So will you not depreciate it over the 5 years? No, you will depreciate, and hence this is the second possible error. You will depreciate property 1 and also property 3 even if it is investment property. The difference between the fair value and the carrying amount has been recognized in the statement of profit and loss. Now if you look at property 1 and property 2, ideally this is an upward revaluation. So if I look at property 1, there is an upward revaluation of 8 lakh minus 625. So this is 1 lakh 25,000. This is an upward revaluation. And where will the upward revaluation go? Well, it will go to the revaluation surplus as a part of other comprehensive income. It will not go to the statement of P&L. Property 2, if you go to see, you are comparing 9 lakh 80 with 9 lakh 50, and hence there's a downward revaluation of 30. And where will the downward revaluation go? To the statement of profit and loss. So to the extent of property 2, it is correct to take it to the statement of P&L. Property 1 is wrong. It will go to the other comprehensive income. You cannot net off and show net. Both of these are different assets, different balances, and hence it will be shown separately. For property 3, it should not go anywhere because you have to follow the cost model. Not to P&L, not to revaluation. So you have to follow the cost model and show it at 11 lakh 20 only. The properties are shown under the property, plant and equipment heading in the balance sheet, which is also wrong. Property 1 and 2 can be shown, but property 3 has to be shown in the investment property heading. Now, analyze whether the accounting policies adopted by the company in relation to the given properties are in accordance with Ind AS. Clearly not. If not, advise the correct treatment. We have discussed that. And present the extract of the balance sheet for the year ended 31st March 21. So if I look at the extract of the balance sheet in my PPE, I will see property 1 and property 2. Property 1 is at 8 lakhs because I am following revaluation model. Property 2 is at 9 lakh 50, and hence in my PP I'll see 17 lakh 50. Acha, when I look at investment property, that is property 3, this will appear at 11 lakh 20, and that's it. Acha, if I look at my other comprehensive income, in my other comprehensive income, there will be a revaluation balance which is attributable to property 1, which is I think around 1 lakh 25, and in my statement of profit and loss, there will be a 30,000 expense pertaining to these properties. Further, in my statement of profit and loss, I will also have depreciation. So if I total up 75 and 70, that is 145 and 80, I think 2,25,000 will be the depreciation that will also record in the profit and loss account. Further, in my notes to accounts, I will also disclose a fair value of 13 lakhs attributable to investment property, and if data is available, I will also give the disclosure for the assumptions as well as the methods used. So these are the important questions of Ind AS 40 investment property. This standard has been asked, and you can see the last 3 questions that we did were all exam questions. So most of these questions come along with calculations, some bit of PP as well as investment property identification and accounting. So do this properly, and I think in these 30 minutes you should have a fairly good understanding of the topic. I hope this video has been helpful. Please do like, share and subscribe, and please mention your comments in the comment box. Till the next video, good luck and see you. Bye-bye.